What's up, everybody? Today we are going to be taking a look at a stock that has probably given a lot of people a bunch of headaches. It is PayPal. And the reason it's probably given people headaches is, well, if you look at what's happened to the stock price over, this is the last 10 years, it looks like, this doesn't even look like a stock chart. This looks like a mountain. This looks like a topographical map of the Smokies here. It just comes up to 300 and then it's been really ugly since then. Yeah, $300 a share is what it traded for in 2021. And now it's not even a quarter of that price today. So we're going to see, is PayPal decent value? Is it really cheap now? Was it really expensive before? Is the fair value somewhere in the middle? Let's get to it. So I brought in a bunch of data on PayPal into my little handy dandy Google sheet here. And you can see the revenue and earnings have just been pretty much going up over time. This is a beautiful looking graph right here. You would never know that they had some crazy spike and now some crazy crash. Revenue growth, if we look at it, it was about mid-teens, and now it's slowing down more in the past few years. So we're looking at mid-single digits, maybe high single digits. One thing, the operating margin on this company has been incredibly consistent. They've been between 15 and 18% operating margin pretty much forever. So this doesn't look like a dying company. When I see the metrics on a dying company, normally I'm looking at revenue that's either stagnating or declining and margins that are being squeezed. When margins are going down over time on a company, that could be a sign that a company needs to lower prices to protect their market share. But for PayPal, in spite of the fact that they have a ton of competition, I mean, these payment processors, there's tons of alternatives nowadays. People have been saying that Apple Pay is going to eat PayPal's lunch. And now with Google Wallet and Apple and all these companies, that PayPal is really just a dinosaur. But the numbers don't reflect that to me. Looking at their most recent earnings report, I think something that is scaring some people is the revenue growth is definitely dropping. So, I mean, this is a company that, as we saw, used to be growing at, maybe 15% annually on the revenue. And now, we're looking at low single digits here. This earnings report was, really only growing a few percent. Yes, it's true that their transaction margin grew 7%. So this is basically money to PayPal after paying out bank fees on credit cards, fees that they might have to pay out to Visa, MasterCard, other people. So yes, this is growing decently, but in the long run, if the actual total payment volume is not growing fairly robustly, then this transaction margin growth year over year, it's going to slow down as well over time. One thing that's always annoyed me a little bit about the way that PayPal reports their numbers is they don't really provide much transparency into the profitability of their various segments. So here you can see they break down their revenue by sub-segment here. So if you go online and you order something and you pay with PayPal, that's probably being included in this branded checkout right here. And we can see that that's about 30-ish percent, 29% in the most recent quarter of their total payment volume. But this is really driving the bulk of the profitability. I mean, this segment right here, you just go online and you pay with PayPal. This is the core of the company. And this is certainly the majority of their profits coming from this subsegment. But you actually wouldn't know that by just looking at this earnings report. They don't give you details on what's the profitability of Venmo looking like. What's the profitability of all these other things looking like? Like, I want to know. Venmo has shown a lot of growth. I think, where did they say they were growing like TPV by 20% year over year? That was somewhere in here. And they've talked about expanding their Venmo debit cards, and they have PayPal cards. But, Venmo is possibly not even profitable right now. This is really a growth part of this company. But I want to know, how close is Venmo to turning the corner on really adding to the bottom line of PayPal? Well, it's really hard to tell by just looking at PayPal's numbers because they don't give you that good detail here. One thing I like about PayPal is that they are returning a lot of money to their shareholders right now in the form of buybacks. $6 billion spent on buybacks over the past 12 months. That's quite a lot. That's pretty much all their earnings are going into buybacks. So whatever money they earn, it's coming back to the shareholders. They're reducing that share count 7% year over year. Also, I'm so glad they don't do this anymore, but PayPal in previous earnings reports, what they used to do, they wouldn't report the net reduction in shares. So if they bought back, say, 9% of shares, but they also increased the share count by 3% through their share-based compensation plans, then they wouldn't report, oh, we had a net reduction of 6%. No, they would just say, like, we reduced the share count by 9%, which is really deceptive. And honestly, it's only PayPal that I've ever seen report share repurchases in this way. So yeah, I'm glad that they're now kind of reporting a little bit more transparently here. That's definitely was an annoyance of mine in the past. They also reaffirm their guidance for this year. They say, hey, we're going to repurchase another $6 billion in shares. So pretty much all of our free cash flow is going to go towards that. They're anticipating 4 to 5% growth in their transaction margin. And yeah, let's put some numbers in to PayPal going forward and see, is this stock a good buy or not? So you can see the assumptions I made in my base case. I'm assuming that PayPal grows their revenue by about 5% every year going forward for the next 5 years. That seems fair, seems reasonable, very achievable, I think. Giving them operating margins of 16%, which is pretty much in line with where they have been. I'm going to assume that their free cash flow margin stays roughly in line with where it is. And I'm going to give them a multiple of 15, which, they have traded it crazy expensive in the past, up to over 80 times at their peak. Of course, I think that was kind of insanity. But I think for a company like PayPal, a company that is still growing, even if it is much slower than it grew in the past, a company that has steady margins and quite decent margins at that, and no real significant debt to talk about, I think a 15 times multiple is fair. It's not too optimistic, certainly, for the company. And we can see that with those assumptions, that gives us a 13% annualized return for buying PayPal stock at its current price today. And if we want to get a sense of, well, how bad could this be or how good could it be? In my bear case scenario, I'm assuming no growth on revenue going forward. I'm assuming that operating margins are towards the bottom end of where they have been, and free cash flow margins a little lower as well. And I'm giving them a 10 times multiple, which is pretty much lower than they've ever traded at, but I think would be, fair if they really stopped growing. And we see that, well, if this scenario takes place, then you're going to be down a little bit on your money over 5 years. So that won't be too good. And on the positive side, if we say, okay, I think that PayPal can continue to grow at high single digits going forward, I think the operating margin and free cash flow margin are going to be towards the upper end of where they've been over their recent history, and I'll give them a 20 times multiple, well, then in that case, we see that would give us a 25% annualized return. Another way to think about that would be, okay, if I'm discounting all the future cash flow at 10% for every year, then if this scenario comes true, that means that I think a fair value of the stock today would be 130. So now you might be wondering, how in the world did PayPal trade for $300? Well, the answer is that stocks can become really quite overvalued or undervalued based on sentiment. I probably don't need to tell you that stocks are insanely volatile, but if you're wondering what assumptions we need to make to get a $300 fair value for PayPal, I mean, let's assume that they grow 20% every year for the next 5 years, that their operating margins are off the charts good, and free cash flow margins also off the charts good, and we give them a multiple that's in line with like huge tech companies, then okay, fine. Now we finally get a stock price that's in the 300s. Obviously, I think that these numbers are a bit crazy. So I think, yeah, this was quite exuberant, this price over here. But as far as where it's trading at today, I think it's offering decent value. I don't know if it's the best buy, but I think it's okay. I think you have to ask yourself how realistic or how conservative are these assumptions that I put in here for the base case. Because if you think that it's going to hit this base case or outperform it, then, I mean, getting 13% or more every year for 5 years, that's an excellent investment. As the stock price moves, if you're looking at this in the future and maybe PayPal has fallen to $60, then, you might be looking at high teens per year for this company, assuming nothing really fundamentally has changed. If PayPal goes up to $100 a share, then assuming that this base case comes true, maybe you don't think that PayPal is a great investment anymore. Whatever you believe, if you're still listening at this point, then subscribe to the channel. I'll upload more videos like this. If there's companies you want me to look at, leave that down in a comment below, and hopefully I will see you next time.